Hello everyone, welcome to this video in which I will present my investment thesis in S&P Global. As a disclaimer, this is not a buy or sell recommendation, I am only expressing my own opinions. S&P Global was founded in the 19th century and bought by McGraw-Hill Corporation in the 1966. Then in 2013, McGraw-Hill sold all its business in book printing to a private equity for $2.5 billion. And then the company changed its name to McGraw-Hill Financial, and then again in 2016 to S&P Global Incorporated. They provide data that we could divide into debt rating data about public and private entities, and data about indices they calculate, and the price assessments of other securities like commodities. The revenue comes from four segments. From rating, market intelligence, Platts, and Dow Jones Indices. As we can see here in the slide, the information that I highlighted, they provide data about commodities, information to airlines, steel companies, utilities, information about credit ratings, they calculate indices, so they are in the core of the financial system, and it is a really important company, which maybe a lot of people don't understand, or they only know what they do about the ratings, but there are a lot of things they do, and most of the people don't know. The first segment, as the most important one, at least by revenue, is the ratings. They provide information about the solvency of an issuer and try to measure the possibilities to repay the debt they issue. There are three main players: Standard & Poor's, Moody's, and Fitch. The rest are too small to. They are so small that the market don't consider them as a main player. So these three main players, which I said, Moody's, S&P, and Fitch, has 90% of the share, of market share, and S&P and Moody's has 80%, which is quite impressive. And it's an oligopoly, or better said, it's a duopoly between those companies. But I wouldn't consider them as rivals, because, as I am explaining here, Moody's rates the expected losses on an investment in case of default, and S&P Global just rate the default probability. So the information they gave about a issuer or a bond or some kind of liability is not completely the same. So the information can be complementary. So that's why I think that they are not rivals. I don't have any information about what exactly Fitch rates, but they are a second tier player in this game. So what do they rate? They rate bonds and loans about government, municipalities, or corporates. Also, they rate structured finance products like CDOs, CLOs, asset-backed, any other kind of asset-backed securities. As I said earlier, they measure probability that those entities will be able to repay the debt they receive from the lenders. There are two big groups in the ratings for all the players. One called investment grade, which in the code of S&P is from AAA, which is the highest, to triple B, sorry. And then there is the speculative or junk, which goes from double B to D. As revenue, we could divide in two types of main sources, which is transaction and non-transaction. They are around 50% of the revenue of the segment as of 2019. And transaction comes from new debt issuances or new companies that didn't have any rating before. So this transaction revenue comes from one-offs, which one debt is issued, they earn money from that, or a company needs a rating to just for investors and or financial institutions, so they earn money once. And then the non-transaction revenue comes from annual fees from the surveillance of credit ratings of a company or entity or whatever, to if they follow how is their financial health and they keep on updating the credit rating, they earn money for that. It's more about like a subscription revenue. In this slide, which I took from the Moody's presentation, we could see why they should or entities want to have a rating from Moody's or S&P or Fitch. So what we could see here is if a company wants to issue $500 million in debt, in bonds, if they don't have any rating, they will issue that bond at a 4.3% interest rate. And if this bond was rated by Moody's or S&P, the interest rate would be 30 basis points lower. So after 10 years of that bond, they will be saving $15 million in expenses. So that could be the maximum amount that the company will be able to pay to these rating agencies for their rating. As I say, it's an oligopoly. It could even say a duopoly because they are too big, or they have 80% of the market share. So that's a lot. And they are quite, as I heard and I or read somewhere that I cannot confirm right now, if a U.S. public company wants to issue debt, he needs at least 2 of the 3 big rating agencies rating. So if you are a big company and you don't have S&P and Moody's or Moody's and Fitch, or this all these companies, if you don't have 2 of these 3 rating agencies rating, maybe your issuance will be more difficult, or at least it will be more expensive for you as a company. Their moat is based on a reputation. Financial industry does not pay attention to small players, so that's a big moat. And they have a strong pricing power that they increase every year with a 50-ish gross margin, which makes a great business. As I used to say, if they drove through the great financial crisis in 2008, I think there is nothing that they can destroy them. And even they have a lot of power, because if they give a good rating to an entity, it makes easier and cheaper to get debt issued. So their margins and their profitability expands. The other way around, if they give a bad rating, their debt will be more expensive and the company can declare bankrupt. There's also something which is quite special for me, or I consider quite weird, is that they have a wholly owned credit rating agency subsidiary in mainland China, which Moody's has a participation of the 30% in China Chengxin International Credit Agency. So that makes, for me, shows that they have a really strong reputation that makes that happen. So right now they can rate in in the third biggest capital market in the world, which is China, and probably will be the second one in the following years. So what I see is that China, as a communist country, or at least with a communist party in the government, is really opaque. So what I understand is that in order to be more attractive to international investors, they want to be rated, the companies should be rated as Americans. So this gives more trustworthiness to institutions and make them more attractive. I think that this is a huge opportunity for S&P to grow and to make their moat in China, which I think is not a joke in any way. The second segment, there is the market intelligence. It's an all-in-one software, which its business model is subscription, provides information about different areas such as financial, regulatory news. They make reports. So as I see, it's like a Bloomberg terminal, but with more diversified data, which I think it's really interesting. Users goes from investment banks and private equities, banks, issuance corps, governments, regulatory agencies, academic entities, and other kind of professional services like auditing, consulting, and law. As they say, data to make the best decisions, and they provide a lot of type of data in one place, which I think it's great. On the right, you can see a report from market intelligence. The market intelligence can connect to Salesforce to combine the S&P market intelligence with CRM, and also they have another expansion. I wouldn't know how to explain exactly, but it's another software that is inside market intelligence that called Panjiva. That is a platform inside of market intelligence that gives information about global supply chain. So that's really versatile software. In 2018, they acquired Kensho, which is artificial intelligence data science company. I see clear synergies between these two companies because Kensho's technology will allow to increase the value of the data that S&P has, because S&P has a lot of data that might not be well used, or it was not that good optimized before, and with Kensho's know-how, they can link the data 100 times faster, which I think they made a good acquisition. As a curiosity, and there's something that I read in some places, a really strong knowledge of Kensho was the natural language processing, which is a really interesting part of the artificial intelligence area that, for example, can be used to analyze and transcript the conference calls and see how and that this could help to read between the lines what the insiders are talking about. I think it's quite interesting that. The third segment is Platts. This is not a well-known segment. It's a really interesting segment because it's 92% of the subscription revenue, and what they do is they provide data of market data. They analyze that data, and they give price assessments about mostly commodities such as oil, gas, electricity, shippings. And this is important to define correctly, because they do not set prices. They just give price assessments from long-term contracts and the spot. So they don't really care if the price goes up or not. They just tell the markets how is the supply and demand. And finally, the S&P Dow Jones Indices is a joint venture with International Intercontinental Exchange, which S&P owns the 73% of this joint venture, and provides data of very well-known indices, which are S&P 500 or Dow Jones Industrial Average. But there are other not that well-known. For example, S&P 500 Growth, S&P UST Bonds, S&P GSCI, that is about a basket of commodities. But there are a lot of types about US equity, global equity, or SEG, which is, there are a lot of indices that S&P calculates. These indices are created and they are created by S&P, and they are used as benchmark for ETFs, for asset managers and so on. And the income comes from asset linked fees, which is 67% of the revenue, and they also earn money from data providing fees. It's a great business with a 60% plus operating margin. And it's growing quite fast. Things that I found that could be controversies, and which are not good or bad, or that are seen like bad for the people, but they could be not that bad. For example, indices used to go up in the long term. So, this happens because the stocks that goes down, the stock price goes down, in the end they get removed from the index and they are changed by a stock that is going up. So this has a bullish bias. And also right now in 2020, FANG stocks are around 25% of the S&P 500. So this, in my opinion, creates a distortion in the index because maybe it's too concentrated. But the thing is that these companies are the biggest, the healthiest, and the most attractive companies in the world. So for me, even if this is controversial, I think this benefits S&P because makes more attractive to invest in their indices. So this will provide them more money in the future. And also in the credit rating agency side, their bad adjustment on the subprime ABS was one of the pillars to the Great Financial Crisis, which is really bad information, or it's really bad opinion on them. But even this event, their prestige was not deteriorated, and they keep on rating. Right now they rate less structured finance products, and they are more focused on other type of liabilities. But even if this is a great company with a great margins, I see some catalysts which I divide into the primary ones and the secondary ones. The primary ones are the increase in the issue of debt from public and private entities and the index investing. And the secondary is the SEG rating trend, which is also strong, but I don't think it's that strong. The first one is that the world has been fueled by debt in the last decades due to populist politicians and dovish central banks. And right now, because of the COVID, governments are issuing and will issue more debt in order to subsidize people and businesses. Also, these companies will issue debt for in order not to go bankrupt, and as the and they will refinance the debt they had already with lower interest rates. Also, most of the central banks in the world are monetizing the debt that there is outstanding, so that allows to issue even more debt, primarily to governments. Here we can see on the top left the balance sheet of the central banks as percentage of the GDP of each country. Top right, how is the public debt held as percent of the GDP in the United States, and how Peterson Foundation forecast, which is not good news at all. And also in the top, in the lower part of the slide, we can see how the non-financial corporate business debt securities has gone up for the last 35 years. Here I want to talk about index investing. I think it's a really strong trend, as we can see in the image. It has gone up for the last 30 years, and I don't think it will stop. But there are strong reasons to keep on growing, because it's easy and cheap, that makes really attractive to small investors. So I think this trend will continue in the future. And this is quite interesting thing, that the 4 biggest ETFs as of February 2020, measured by assets under management, are follow the S&P or the Dow Jones. So you have to think that S&P earns a percentage of the money they manage. So this is a great news for S&P. And then about ESG rating trend, as we can see, ESG is almost in any segment in ratings. They evaluate the ESG of products. This data then appears in the market intelligence software. There are ESG indices, and obviously, as Platts is all about commodities, they give their opinion on ESG in their commodity reports and so on. Now I would like to talk more about their financials. Here we can see their balance sheet, their assets. So we can see a quite strong cash position, with at the end of 2019 of $3 billion, and their main part of the non-current assets is the intangible. So we can see that most of their assets are cash or intangibles. In the liabilities and equity, there's nothing too much to say about, rather than they have debt, they have net debt, but it's controlled. And but there was a new on August that I will comment now, which is that they issued $1.3 billion at really low interest rate to repay some notes that were that had a higher interest rate, which will be in the long term will be very beneficial for S&P Global. And then this is my valuation part, which I created 3 cases: one the base case, another one the bear case, and the last one the bullish case. So I divided the ratings in which I forecast the money they will make in the future by segment. As you can see, only the actual data goes until 2015, because before 2015 did not make too much sense because the company was not the same. So I think that makes more sense only to consider from 2016. And as we can see here, a 4% margin and ratings growth and 8% in market intelligence, and keeping the operative margin constant with the numbers you can see in your screen. I calculated my total revenue model and an operating profit, a free cash flow, and a return to shareholders. The return to shareholders is what I consider is buybacks plus 80% of the dividends due to the effective tax rate of these dividends. Also, as a consideration, and what they usually place in their presentations, they try, or what they have done in the last 5 years was to give the 75% of the free cash flow to and they return it to the shareholders. So that's what I did to make this discounted cash flow model, in which I considered, in this case, a buyback yield of 1.5% of shares each year. So this gives me $600 per share. In the same case, the same situation for the bear case, with lower growth and lower margins, which I think it's quite pessimistic, and it's like the lowest case or the lowest situation I could imagine, because really low margins, really small growth, and in this case, with a buyback of 0.5% each year, it gives me $228 per share. And then the bull case, with higher growth, higher operating margins in all segments, and a buyback yield of 2%, gives me over $1,000 per share, which maybe this is too optimistic, but I think it's not crazy to think this high growth and these high margins. Then I would like to compare S&P and Moody's, because they are really similar business. And for example, for ratings, they have a similar revenue and operating margin. But what I think it's attractive about S&P is that they have the 50% of recurring revenue, and Moody's only has, only compared with S&P is 36%. So what I see is that, as I said, they are duopoly, and I don't see any material danger about their rivalry. So I'm not worried about them. But I consider that S&P has a better business in rating. And about analysis, or what it's called, Moody's call it market analysis, and Moody's analysis and S&P call it market intelligence, but it's pretty much the same. They have really similar revenue, but S&P has a 2 to 3 percentage points better operating margin, and S&P has a 97% recurring revenue, and Moody's 86%. So they have a really similar product, and there is a very small churn in both sides. So I think it's a really sticky product. And from the Platts and Dow Jones Indices segment, Moody's has none. So I couldn't compare them here. And as a lot of people will know, is that Buffett has around the 20% of Moody's right now. The history of his investment comes from when Moody's was spun off from Dun & Bradstreet in the year 2000, where Buffett invested $500 million in Moody's to acquire 15% of the company, and right now due to buybacks is at 20%. So in that time, Standard & Poor's was part of McGraw-Hill Corporation. So what I think is that by that time, Buffett couldn't invest in S&P Global, or if he wanted, he will need to buy all the big book printing business, which is not as good as S&P rating and all the other segment that it has. So I think that's why Buffett investment on Moody's and not on S&P. And also right now he has a 20% of the business, so it's a quite big chunk of the company, and it's difficult to reduce by a significant amount of its investment. And also what I can consider and what I think is that if you want to be more exposed to the credit rating agencies, it is more interesting to buy Moody's, because a biggest part of its revenue comes from the ratings. So it's more intelligent to buy Moody's. S&P is more diversified. And there's nothing else to say from my side. If you have any questions about a company or something that I'm missing, something I am wrong, please let me know down below in the comments, or write me on Twitter. My DMs are opened, and see you in the next time.